Are any of you interested in investing in the stock market? How much do you know about that? For example, which is more expensive, a share of Google at $599 or a share of Zynga, the company that makes Farmville and Words with Friends, at $3? It seems like you can afford some shares of it, no matter what your budget. Here's another one. What does Pepsi make the majority of their profit on? These are all basic questions that an investor would know the answer to. If you're interested in investing in the stock market, you need to know how to answer them also. If you're curious, I'll share the answers with you at the end of this presentation. Today, I'm going to talk about why I know the answers and a way that you might find useful to learn also. I know the answers because for the last 15 years, I've been a member of an investment club. An investment club, you say? Isn't that something for little old ladies? Well, actually not. Being a member of an investment club is a fun hobby and an ideal way to learn about investing in the stock market. Of course, you might ask, why would I want to do that? Isn't the stock market just a big casino? Here are 5 reasons you might want to learn about investing in stocks. Maybe some of you can identify with them. First, most of us have some financial goals in life that are probably going to be expensive. You can save money, but if you invest your savings, you can put your money to work earning more money. Some people feel that a risk-free way to invest is in a savings account. But according to the FDIC, average rates on savings accounts recently were below 1%. As you can see, the best rate you could get if you tied up your savings in a 5-year CD would be only 0.77%. The latest annual inflation rate reported by the government is 2.1%. If inflation stays the same as it is today for the next 5 years, you'd actually be earning negative 1.33% on your savings each year. You'd end up with less purchasing power than you started with. Here's another reason to learn about investing. Some of us would like to retire someday, but how are we going to support ourselves? Pensions are going away. According to information provided by the Bureau of Labor Statistics, only 35% of private industry workers were covered by pensions in the early 1990s, and by the end of 2011, it had gone down to only 18% of workers. That isn't a good trend. We're expected now to be responsible for our own retirement by investing in plans such as 401ks and IRAs. Have any of you had any education in how to do that? I hadn't. Despite being able to manage our retirement accounts, training in how to do so effectively is sadly lacking from our educational curriculums. Which leads us to reason 3 to learn more about investing. The amount of information out there is overwhelming. There's an infinite body of knowledge and information that's bombarded at us from all directions. But maybe there's too much choice. In 2006, a famous psychologist from Swarthmore named Barry Schwartz gave a TED Talk titled The Paradox of Choice. He discusses how at a certain point we receive diminishing returns from having too many choices. This is because with more choices, we have more fear that we're making the wrong choice. And not only that, we end up having less satisfaction with the choice we do make because we keep thinking about all the alternatives that we passed up. Having too much choice affects investors. In 2004, researchers at the Wharton School of Business did a study of approximately 1 million investors at approximately 2,000 companies with voluntary retirement contribution programs. They found that for every 10 additional mutual funds offered as investments, the rate of participation in the retirement program actually went down by 2%. This happened even when participants received matching funds from their employer. Even free money didn't help them overcome their anxiety. If we only look at investing in stocks, we're looking at almost 10,000 choices. We have the ultimate freedom to choose, but we don't want the anxiety that comes along with having to do so. So, we tend to avoid doing anything. We need a way to sort through all the choices. How can we do that? Some of us turn to investment advisors, which brings us to reason 4 for learning to do this on your own. Unfortunately, investing is different than the business of investing. Most sources of information that you interact with are involved with the business of having you invest, not about whether you're successful. They make money whether you gain or lose. In the book, Where Are All the Customers' Yachts?, professional investment managers are described this way. At the close of the day's business, they take all the money and throw it up in the air. Everything that sticks to the ceiling belongs to the clients. You don't get away from these fees if you put your money in a mutual fund. They charge you to choose investments for you. Their fees reduce your returns. And in order to attract you as an investor, mutual funds need to show positive results in short time frames. Unfortunately, this works against them. This graph was created with data developed by Robert Shiller, who won the Nobel Prize for Economics in 2013. As you can see, the shorter your holding period, the greater your chance of negative returns. If we pick stocks ourselves, we can take a longer-term perspective and increase our chances of a positive outcome. Time is a very important factor for success that we as individual investors have access to that a mutual fund manager doesn't. Choosing mutual funds is also not a no-brainer. It can take just as much work to determine what mutual funds to invest in as it takes to pick good stocks. Personally, I find learning about companies far more interesting. I also find there's far more information available to use to research them. So those are 5 good reasons that you might have to want to learn more about investing in stocks. But what does it take to become good at it? It's not rocket science, but it's not just shopping either. You're not buying shoes. Buying stocks is deceptively easy, but that doesn't mean you'll make money buying them. To learn how to do it wisely, you'll need education, structure, and participation. A typical investment club provides you those 3 things. It's a group of people who meet once a month to learn how to invest by actually making real investments. You get education because at each meeting, most investment clubs discuss an educational topic. They also pick stocks to invest in. This gives them practice applying what they've learned. In addition to education, a club provides you with structure to help keep you on the right path. For example, you need to learn to overcome your emotions. Over the last 20 years, an investment in the broad market would have risen almost 10% a year. But on this journey, you would have had to have held on through a couple of terrifying drops. In 2003, there was a drop of 46%. In 2008, there was an even worse drop of 52%. The problem was that most people got in here, and then panicked and got out here and here. In reality, they should have made exactly the opposite decisions. But at the high points, all their friends were talking about how well they were doing in the market. And at the low points, everyone was scared stiff. You need to learn to overcome this tendency to make decisions based on your emotions to be an effective investor. Being part of a group can help you make sure that you do that. Structure also means regular attention. You get this by having a club meeting on the calendar each month. An investment club is also often a social group. My own group started out as a mom's night out with friends who shared my interest in investing. Our meetings always include good food, wine, and conversation. If it's fun, it keeps you motivated to attend. Finally, it takes participation to learn to be an investor. You have to try doing it with real money. Virtual portfolios just don't cut it. Investing is like cooking. You can read all the recipes you like, but you don't become a good cook if you never make any of them. As we were discussing, emotions can undermine making good investing decisions. Until you face those emotions with real money on the line, you will not learn how to keep them from getting the best of you. In an investment club, you pool small monthly contributions and actually make real investments. This means you can have the full learning experience you need without as much downside risk as doing it entirely on your own. If you get a group of 4 to 8 people to each put in $25 a month, you have enough money to build a portfolio for less than the price that you'd pay for a dinner out. I've personally always considered it a fee for a monthly class. I felt that even if I lost the entire monthly contribution, I'd have gained $25 worth of knowledge. In reality, I've put approximately $8,000 into my club over the last 15 years. I've taken $5,000 out already, and I still have an account worth $8,700, so I've actually gotten to keep my tuition along with my knowledge. Of course, you might have some questions about whether a club would work for you. You might feel it's hard to work in a group. Well, that's true. You need the right group. But if you find them, it's actually been shown over and over that groups have the potential to make better decisions. Diverse backgrounds means you can get varied input and perspectives. In studies about investment clubs reported by Brooke Harrington of Stanford University, she shows how the better performing clubs were the ones with the most diverse membership. Investing takes time and effort. In a group, many hands make light work for each of you. And finally, the most successful investors learn to develop a plan and stick to it. Group reinforcement is very valuable when emotion pushes you incorrectly to change your course. It's actually been proven that groups make more rational decisions than individuals. You may think you don't have the time to do this. Well, neither do I, but without something on your calendar, you probably won't do anything. I can't say I've been totally prepared each month for the 15 years that I've been involved. But even so, the fact that I did something each month has added up to a lot of knowledge. In fact, since I shared the workload, I probably ended up putting in less time than if I had had to pick all my investments on my own. You may have heard that investment clubs don't perform well. Well, neither do beginning golfers, and neither do mutual fund managers. Here's a report from a recent study by the people who are responsible for something you may have heard of, the S&P 500 Index. It's a lot of information, but what I want to draw your attention to is this column. It shows that between 60 and 80% of active fund managers fail to deliver returns higher than passive index funds over a 5-year period. Results like these are the reason that the general advice is to invest in an index fund if you don't want to learn about investing. But the results from my own club show how spending the time to learn about investing can pay off. Here is the annualized growth of my investment club compared to the growth of the Vanguard Index 500 fund over the past 5 years. As you can see, my club has beat the index by more than 1%, meaning we earned almost an extra $5,000 over the 5 years. Not bad for a few hours work each month. We also like to compare how we're doing to Warren Buffett. As you can see, for the past 5-year period, investments in my club produced a better return than if we had invested in the stock of Warren's company, which is Berkshire Hathaway. How many amateurs do you know that beat Tiger Woods? Many people just like you have gone from feeling overwhelmed about investing to feeling empowered because they were members of an investment club. Here's how you can get started. You'll find lots of guidance online on our site, bivio.com, on the mechanics of setting up a club. Find a group of 4 to 8 people that share your interest in learning about investing. Make sure they understand that successful investing takes time. They should be willing to make a commitment to participate in your club for no less than a year, but ideally for longer than that. They may not be your closest friends, but they should be people you enjoy spending time with. Figure out a time that's good for you all to meet each month. Reserve that time on your calendar for at least a year. Get your group together, jump in, and get started investing. Don't wait until you know everything, because you'll never start. Sooner than you think, you'll be at a point where you can easily answer the initial questions that I asked. Here's what you will have learned. A stock is well valued when it's priced at a reasonable multiple of its expected earnings. We call that price to earnings ratio, or PE. Even though Google has a higher stock price of $599, it is reasonably valued at a multiple of 19 times next year's expected earnings. Zynga is priced at 142 times next year's expected earnings, so it really isn't as cheap as it appears. It is priced like filet mignon, and Google is only priced like hamburger. An investor will want to know what it is about Zynga's business that justifies that difference before he'd make an investment. How about how Pepsi makes its money? Did you know that Pepsi isn't really a soft drink company? Pepsi actually makes most of their money from their snack foods division. If you're interested in purchasing Pepsi stock, it will be more important to get a feel for how sales of snack foods might change in the future than for how the sale of soft drinks might change. You will find in your investment club that your knowledge will grow along with your portfolio. At the beginning, your club will just be about learning to invest. Over time, your club will be about the discipline of regularly researching and investing and managing a portfolio. You will have gained the confidence and network of connections that you need to make your own financial decisions. An average bivio club has assets of over $100,000. That is a real portfolio. At $25 per month per member and a little bit of time each month, in the time it takes to accumulate those assets, the experience to manage them has developed also. Over time, you have accumulated both money and wisdom. And you will have accumulated even more. Those who study what motivates people and makes us happy are mostly in agreement. Money isn't the key to happiness. What really gives people meaning and happiness is a combination of 4 things: control over what they're doing, progress in what they're pursuing, being connected with others, and being part of something they enjoy that's bigger than themselves. That's a perfect description of what you add to your life when you're a member of an investment club. You're taking control over your desire to learn about investing, you're moving forward, you're sharing time with friends, and you're participating in the world of finance instead of sitting on the sidelines being overwhelmed by watching it all. One of our clubs summed it up very well. Get started now, and this could be you someday.